Imagine you have some money saved up and want it to grow, but the idea of picking individual stocks or bonds feels overwhelming. You've probably heard about mutual funds, but what exactly are they, and how do they work? Well, that's exactly what we're going to explore today. Think of a mutual fund as a giant money pool where many people contribute their savings, and a team of professional fund managers invests it in a mix of stocks, bonds, or other assets. This way, you don't have to worry about choosing individual investments on your own, and your money can grow with the expertise of professionals. In this video, we're going to break it all down step by step. We'll explain what mutual funds really are, the different types you can invest in, how your money actually moves and grows inside a fund, the benefits and risks you should know, and some smart tips for making mutual funds work for you. By the end of this hour, you'll have a clear understanding of how mutual funds can help you grow your wealth safely and efficiently, whether you're saving for retirement, a house, or just building long-term financial security. So, if you've ever wondered how people invest without constantly stressing about the market or analyzing every stock, stick with me because we're about to make mutual funds simple, understandable, and surprisingly exciting. Now that we know what a mutual fund is, let's dive deeper into how it actually works and why it's such a popular investment tool. At its core, a mutual fund is a pool of money collected from many investors, which is then managed by professional fund managers who decide where to invest that money, whether in stocks, bonds, or a combination of different assets. This means that instead of worrying about picking the right stock or timing the market perfectly, you can rely on the expertise of these managers who analyze the market, study trends, and make investment decisions to grow your money. The money you invest buys units of the fund, and the value of these units, called the net asset value or NAV, changes every day depending on how the underlying investments perform. There are different types of mutual funds designed for different goals and risk levels. Equity funds, for example, primarily invest in stocks and aim for long-term growth, but can be more volatile, while debt funds invest in bonds and other fixed-income instruments, offering more stability but generally lower returns. Hybrid funds, as the name suggests, combine both stocks and bonds to balance risk and return. Each type serves a different purpose, whether you're looking for rapid growth, steady income, or a mix of both. As your money grows in the fund, you earn returns in two main ways: capital appreciation, which is the increase in the value of your investment units over time, and dividends or interest, which some funds pay out periodically. One of the most powerful features of mutual funds is compounding, the process where your earnings start generating their own earnings, creating a snowball effect over time. Beyond returns, mutual funds offer several benefits that make them attractive to everyday investors. They provide diversification, meaning your money is spread across many different investments to reduce risk. As we wrap up, let's take a moment to recap everything we've learned about mutual funds and why they can be such a powerful tool for building wealth. We started by understanding that a mutual fund is essentially a pool of money from many investors professionally managed to invest in stocks, bonds, or a mix of assets, allowing you to benefit from expert management without having to pick individual investments yourself. We explored the different types of mutual funds: equity, debt, and hybrid, and how each serves different financial goals, whether it's long-term growth, steady income, or a balance of both. We also saw how your money works inside a fund, growing through both capital appreciation and dividends, and how compounding can turn even small, consistent investments into significant wealth over time. At the same time, it's important to remember the risks involved, such as market fluctuations or interest rate changes, and to choose funds thoughtfully based on your goals, risk tolerance, and time horizon. The key takeaway is that mutual funds make investing accessible, diversified, and manageable even for beginners, and with the right approach, like investing consistently through a systematic investment plan and understanding fees, you can make them work for your long-term financial success. So whether you're just starting your investment journey or looking to optimize your portfolio, mutual funds offer a simple, effective, and professional way to grow your money while minimizing stress and complexity. Now that you have a clear understanding of how they work, you're re-equipped to take the next step towards smart investing and building a secure financial future for yourself.